Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. In this episode of the Moneymakers Investment Trust podcast, I'm delighted to have another chance to talk to Ailsa Craig, who is the co-manager of International Biotech, an investment trust that has started to perform very well after what has been quite a tricky period for the biotech sector. But since last summer, despite fears to the contrary, the sector has been booming, and you've put in a very strong performance over the last year or so, I think it's fair to say. So I guess, if you don't mind my starting with the obvious question, you've had a very good run. Have we seen the best of it?
Great question, and thanks for having me again, Jonathan. It's great to be on. So, like you mentioned, we've had a long bear market in this sector, and it was driven by three reasons or three punches, if you like. The first being that valuations had got ahead of themselves during COVID. And I think that was driven by excitement over new discoveries, so the vaccines and the treatments for COVID. And a lot of people are at home investing, armchair investors, we call them. And so there was a sort of boom in biotech in the 2020-2021 period. So naturally, when that happens, and this sector does go into boom and bust, in favor, out of favor, it swings like that, we saw a correction in valuations. But the second punch was the interest rate environment. And because many of these companies have cash flows expected in the future, as rates increase, the discounted valuation of those cash flows will be lower. So the second punch for the sector was rising interest rates, something we hadn't seen for a while. And then the third punch was politics. And so this was driven by the Trump administration appointing a relatively controversial head of the Health and Human Services Department over in the US. And that caused some ruffles in the industry, concerns that things would change. And then coupled with that, we had tariffs and Liberation Day, which affected all equities, but certainly healthcare was exposed to that as well. So some controversial appointments on the political side meant that the third punch caused the sector to be in a bear market for sort of 3 years. And so we've had a recovery, you're right. We've had a strong recovery since Liberation Day, which was basically the low for the sector and many other equities. But it's been driven by, yes, valuations recovering. We would certainly not say that they were in bubble territory, though. When you think back to the COVID era, I'm going to give an example. There was a company that was valued at $12 billion market cap and hadn't even had their drug in the clinic yet. And that particular company, CRISPR Therapeutics, has now launched a product and is about $4 billion market cap. So we're not seeing bubbly like valuations. Investors are being very careful with their money. They're being selective. They're investing in names that are high quality and that have shown data. And then we've had a huge wave of M&A. So a lot of those returns are crystallized. We've had 15% of the whole of our portfolio acquired calendar year to date, and we're currently in the middle of June. Last year, we had a big M&A year. We thought that was big. And 15% was acquired last year in totality. So we've seen fundamentals improve, M&A picking up, and interest rates normalizing. So all those factors are helping, and politics has calmed down a bit as well. I'm sure I've answered many questions in one, but just as an overview, we don't think we're in bubble-like territory. If we did, we'd be moving into a large weighting into the larger cap, more profitable names. But we still see good value in the de-risked commercial ready stage, biotech 2, we like to call them.
Well, just to put some numbers around this, I mean, I'm just looking as of today, I think the service I use, total return over 1 year, 65.9%. That's not bad at all, I'd have to say. Annualized return over 3 years, 16% per annum, also very good. But at 5 years, 8%, and 10 years, 11% annualized total return. And the shares are pretty close to their all-time high. I think that's fair to say as well.
Yeah.
And you have a market cap around 300 million, I think. So
Yes.
basically the story is biotech's always been volatile. We know that. Higher risk, higher reward. But you think we've still got a lot of fundamentals working for us. Let me just pick up on one, if I may. First of all, which is the interest rate environment. Obviously, been a lot of talk about interest rates coming down. That was one of the factors that people identified a year ago as being positive for the sector. But we're not there yet, are we? Because of what's happened and because of the Iran war, we don't yet know. We'll see what the Fed does this week, but it doesn't look as if interest rates are coming down immediately anyway. How strong a factor is that in the performance in your experience?
Yeah, so there was an analysis done on this. We followed this for as long as we've been looking at biotech because it does have a strong influence on performance for our names. And there was an excellent sell side research report that looked at exactly this. And what they found was it's the rate increase of the rates. So if rates are ratcheted up in a fast way or are brought down in a fast way, that's what impacts biotech. So if we have a dramatic cut in rates, biotech will move hard up. And if you have a dramatic increase in rates, biotech will move down hard. However, if you have just flat, consistent rates, the performance of the sector normalizes. So as long as we don't have strong increasing rates this year, and we don't know if we will, we might do, right? Then the sector should perform as we'd expect. Equally, if we have a sudden dramatic cut in rates, that would give a tailwind to the sector. But if we're steady, things should be okay.
So you would be very happy if President Trump was in charge of interest rate policy, as he'd like to be, obviously, but isn't.
My shareholders will, yeah.
Your shareholders would be for sure. Yes. In terms of M&A, you've highlighted how significant that's been, both for the sector and for you. And of course, what's driving that, or at least what's held to be driving that, is the so-called patent cliff, which is the big pharma companies are seeing a lot of their drugs come off patent protection and therefore need to replace a lot of revenues. Where are we in that cycle? Do you think there's still a lot more to come? You've obviously done very well out of it so far.
Absolutely. The problem has certainly not gone away at all. So, as you mentioned, we're talking hundreds of billions of dollars going off patent in a very short period of time. So, the next sort of handful of years. And taking a step back, this is the deal that the industry has with society. People spend a lot of time focusing on the cost of drugs, the pricing of branded drugs. But remember, industry only gets 10 years of IP life approximately once it's on the market. 10 years it's used up when it's in development, but 10 years actually making a return is a finite time. You don't get other industries that then have to provide whatever technology they've discovered or innovation at a cut down price after 10 years. Their patents continue on for a long time. So this is the deal with society. We want the industry to innovate, and in return, we will pay branded prices for a fixed amount of time. And then forever after that, you can have generic competition, which markedly brings down the price of drugs and basically makes it available for the whole of the world if needs be, because they're much cheaper drugs. So that's the deal. Now, pharma are facing a wave of IP. So it just so happens that a number of mega blockbuster drugs that they make huge cash flows from at the moment will be tipping into the genericization part of their life cycle in the next handful of years. So we've got one drug that Merck has that sells over 30 billion per year. It's an oncology drug called Keytruda. They've got to replace those revenues, and they're not alone. Most of the big pharma names have huge voids appearing in their top line. And these guys want to grow their top line. They're about to lose their top line. So there's huge demand for revenues, and they need them really soon. And then couple that with the fact that these same pharma companies are not as productive in their internal R&D programs. So over the last 2 decades, productivity in pharma has been falling. Why? Because you can't force innovation. Biotech companies, new emerging nimble companies, are very good at it. So you can see what's happened here. Biotech's taken over as the innovation engine. Pharma needs the top line revenues. Plus, pharma have massive cash capacity and leverage capacity to make these acquisitions. But no, certainly the problem is not over. And when we went to the JP Morgan Healthcare Conference in January, which is in San Francisco, and it's the main get together for the whole industry, not just investors, but venture and business development teams, the main bankers at JP Morgan stood up at the beginning of the conference and said, I've spoken to my team, asked them how busy the order book is this year for M&A, and they said we're even busier than last year, which isn't surprising.
And so what is the secret of finding the ones that the big pharma wants to buy? I mean, you've been, I think, disproportionately successful at that compared to some of your peers. Is it something you're specifically targeting when you construct your portfolio?
Not really. I think the reason we've had such a high hit rate is possibly twofold. Firstly, my co-lead fund manager, Marek, has worked in biotech business development in the past. He's also worked in biotech companies and he's founded companies and exited as well. So he's got that industry know-how. He's got that lens that the pharma business development teams have as well. So he knows how to value them, or at least how they value them. He knows what sort of characteristics they look for. And we are investing in those names anyway. So it looks like we've just got the same taste in biotech companies as the pharma biz dev teams. And generally what we look for is reasonable valuations. So if we think a valuation's got ahead of itself, we'll take a step back and we can always buy it back if, something happens geopolitically or what have you. But we won't just buy and hold for 10 to 15 years. That's not our style. We don't think that's how you should approach this sector. We also like to invest in de-risked assets. So we don't want to put all our chips on one clinical readout, for example, but neither do pharma. They've been burned in the past buying a company and spending a fortune on them, only to realize that the phase 3 trial wasn't up to scratch. It either failed or it just didn't beat the competitor out there, for example. So I think we're just looking at companies with a similar lens to the pharma biz dev guys.
I mean, I guess that's something that everybody could do if they wanted to, but clearly you've had more success with that than some. Well, let me just talk also about the political regime. Obviously, we talked about President Trump and interest rates, but we also know that he'd been very keen to get drug prices down. And for those of us who don't follow what's been going on in the sector that closely, there's only a tangential impact on drug pricing maneuvers on biotech. I take that. But can you just summarize for us what actually has been going on that front since we last spoke, or since last year?
Yes, I'll do a little bit of history, though, to put it in context. So Trump, during his first term, aired the idea of something called MFN, so most favored nation, whereby he understandably said, why are Europeans paying so much less, such a discount to the Americans? And that's true. He then left power and Biden came in, and Biden didn't carry on with the MFN idea, but instead he introduced something called the Inflation Reduction Act. And within that, he proposed, and it's now come into force, that a certain number of drugs every year that sell blockbusters can be negotiated, their prices negotiated with Medicare. And that's the federal spender of drugs in the US. So Trump then won again. And he said, alongside tariffs, we would like to see drug companies pull down their drug prices in the US and make them more aligned with Europe, so that he brought back the MFN proposal that he suggested initially during his first term. And there was a lot of toing and froing. He wrote 16, I think, letters to the 16 major pharma companies outlining his concerns about drug prices and the disparity between Europe and US. I don't think his argument was, oh, they're too crazy and high. He certainly called out, in inverted commas, the fat shot during one of his speeches and saying, my mate's been over in London and he's managed to get the fat shot for half the price or whatever it was versus the US. And that's crazy. So he called out the obesity assets, interestingly. Suffice to say, he wrote the 16 letters. They've all since come back and they've sat down at the table with the administration and struck a deal with them to say, we will do X, Y, Z in terms of manufacturing commitment in the US. This is what our commitment will be on tariffs and drug prices. And so there's been negotiation between the industry and the US administration. And we feel like those deals have now been confirmed. We don't know much detail about them, by the way, but we do know that this issue has been put behind us. So when we last spoke, it was still very much front and center for anyone who's watching the industry. But now it feels like it's behind us and we can look forward again.
So the net impact of that is you're expecting a regime that is slightly different, but is more stable in political risk, if you like, than before. Is that what you're saying?
Well, certainly on the tariffs and MFN, yes. On the FDA, So the regulator...
I'm going to come on to that. Yep. Yeah. To the regulatory side. Yep.
I'd say no. So I think of all of the bear cases that we spoke about, I think last time, the FDA, the regulator, is still in flux. And that's still an ongoing issue. We don't have a commissioner at the moment. We've got an acting commissioner, temporary commissioner, but we don't have a permanent one. And there are still senior positions within the regulator in the US that decides whether a drug gets approved or not, up for confirmation of who it's going to take. So the industry is watching very closely. If we get someone that comes in that has strong views on something or other, then it will affect the shares and the companies that are linked to those views, if that makes sense. So we need clarity on that. We haven't got that yet.
Okay. And what's the worst case and what's the best case?
It depends what hat you're wearing. I think if you're wearing an industry hat that has a drug in development that was following a course that was given to them by the regulator, i.e., this is how you should design your trial, this is what we'll do if you were statistically significant, you will get approval, etc., an agreement. If someone comes in that is against those sorts of processes, then those companies will be hit. Very early stage companies, it's by the by because you haven't arranged your clinical trials yet. Companies that are up against the regulator in disease areas that have strong patient advocacy groups, if someone comes in and doesn't agree with input from advocacy groups, that could cause a stir. Or we could get a situation that someone comes in who's very relaxed about the drug approval process, lowering the bar, then, we could get a big surge in valuations in a lot of these names. So it's a watch this space situation.
And how quickly do you think it will be before you actually get a clarity about what is happening?
With this administration, no one can predict. You can predict it's unpredictable, right? I'm afraid I just cannot give an answer to that. I would hope in the next month or so that we get some sort of clarity on the FDA, but who knows?
Right, but is this uncertainty having an impact already on the way that companies you follow are behaving or acting?
No, it hasn't. In reality, it hasn't. So that sounded quite negative then. But when you look at the number of drugs approved last year, it was absolutely in line with what we'd expect and the norm. And we would expect the same this year. So on the outside, this doesn't appear like it's having an effect despite the disruption internally. And it might be because the head of the commissioner made sure that the departments that dealt with drug approvals specifically were ring-fenced and protected during his tenure, and that the cuts that were made, etc., and the changes were very much surrounding that, so support networks, etc., and restructuring. So when you look at it, the data, drug approvals aren't being delayed any more than normal, and the number of drugs being approved are the same. So productivity seems to be okay at the moment.
Right, but I'm thinking in terms of where we go from here. And if you're potentially in this business or you're looking at how much you're going to spend in this business, you might be deterred if you're unsure whether the regime's going to be favourable, unfavourable, or just continuingly uncertain.
Well, it's on the margin that the industry aren't going to stop doing what they're doing because of this. They just want to know the rule book. And once the rule book is stated and made clear, then it's easier for the companies to then go and design clinical trials, for example. So it's nuanced. People aren't going to give up doing what they're doing. They're not that controversial. They appreciate we still need new drugs.
In terms of Robert F. Kennedy Jr., the Health Secretary of the US administration, who is an interesting character and doesn't like vaccines, overall, what has his impact been? Last time we talked about so-called MABA announcement back in June last year. Perhaps you could remind us what that was about and whether that is still a positive, but in the context of what else he's been doing since he's been in charge of the health department.
Yeah, I mean, the commissioner is the key guy. So we had Marty Macquarie as commissioner, who was appointed by RFK. He's the guy that makes much more influential decisions. He's a doctor, obviously. He's now left, but he did introduce, I can't remember if he had this last time we spoke, but the priority review vouchers. So if you meet certain criteria with the medicine that you're developing in the clinic, then they will reduce the time it takes for them to make a decision on approval, which is normally 12 months, to 1 to 2 months. And that's a strikingly positive thing for these names. So if you have a huge unmet medical need, and I can give an example, pancreatic cancer, which has never had a successful targeted next-gen, i.e. not chemo, clinical trial result in history, finally saw a doubling of overall survival for a company called Revolution Medicines. Now, that was striking when it was presented at a medical conference the other day. there was a standing ovation. And I think the presenter even started crying. I mean, this is kind of game-changing stuff. And they have been granted a priority review voucher because pancreatic cancer patients have nothing. And so they will file the drug shortly, I imagine, in the next few weeks, hopefully. And could this drug be approved by the end of the year? That would be unprecedented. So the things that have happened in the FDA seem pretty industry friendly, as long as it fits with society's needs. RFK himself is generally coming down on food, and FDA stands for Food and Drug Administration. So he's keen on getting Americans eating properly and exercising, et cetera, et cetera. So he tends to lean in on that side of the FDA. But the commissioner is the guy that has the most influence in our sector. And that's why we're so keen to see who the next commissioner is going to be.
You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. Well, let's talk also about the outlook from here. You mentioned gearing. You mentioned that last April, after the tariff announcement, you increased your gearing to 20%, which I think is about as high as it's ever been. Where is it now? I read it was around 8%. Maybe it's changed since that came out. And what does that tell us about your appetite for risk within the current environment?
Yes, so the gearing will change every day. You see a snapshot at the end of the month on the fact sheet, I imagine, or Morningstar. You're absolutely right. We went to just under 20% geared on Liberation Day period last year because we felt the sector was grossly oversold. And that was the highest gearing position we've had since Bear Stearns blew up in the great financial crisis, where we did the same then. We're at kind of high mid-single digit at the moment. Bob's around. We're very actively managed. We trade a lot in this fund. We think that's how you can really generate alpha, is by taking profits and adding to names that have been oversold, for example. So we pretty much trade every day. So the gearing at the moment, I would say, is normalized for us. We want to have some gearing. We believe in the sector. And if we felt things were very bubbly, we could take that gearing off.
Okay, so your gearing is roughly in line with average, is it, would you say?
Yeah, I don't have the data to hand, and it would depend what period. But in terms of the normal times, if we took out that 20% last year, which was unusual, I would say this was normalized.
Okay. Can I ask you about valuations then? Obviously, it's quite a difficult art, I would think, to value a biotech company, because obviously there's a lot of uncertainty around what's going to work and then whether it will be commercialized or not. So you use a measure, the one you quote normally is enterprise value to sales. Tell us what those readings are telling us about A, the sector generally, and B, your specific portfolio.
Absolutely. So the way we value the companies is we separate them into three pots: profitable companies, revenue growth companies that have launched their product onto the market. So patients are using them. So they've gone through the clinic successfully and de-risked from that perspective, but they haven't yet turned a profit. And the third bucket is your traditional biotech company that isn't making any revenues or profits. Now, we value the development stage companies, i.e. the ones that aren't making any revenues or profits, and the revenue growth names by EV to sales basis. And we do that by, let's say we had projections of this drug could sell 3 billion by 2030. Pharma would be willing to pay between, say, 4 and 6 times on a multiple basis. So that's how we value them. If a company is in the clinic and they are 1 times 2030 projected sales, that would be kind of reasonable because they haven't got through the clinic successfully. But if they've got through the clinic and they've launched and they're trading at 1 times 2030 sales, to us, that would be a screaming buy. And then if it reaches 5 times 2030 sales, we'd be taking some profits there, unless there was an extraordinary circumstances. And then on the profitable side, we look at PE valuations and how much they're growing. So the Gileads and the Amgens and the Regenerons, all of which make money on the bottom line, and now are big pharma companies themselves. We will look at PE valuations, which are much more familiar with, I'm sure, your listeners.
And what does the numbers look like now?
So on the larger end, the Gilead, the Amgens, etc., they're not looking expensive. These are sort of 15 times to 20 times earnings. They have got as high as 40 in sort of 2015 era when they were double-digit growing top line, double-digit growing bottom line. But each of them, their growth is slowing. They're facing IP expiries, just like the big guys, the big pharma guys. So their multiples have come down because of the lower growth rates. And then multiples of the EV to sales pot, so the revenue growth names, aren't looking too hot at all. So we're talking sort of 2-3 times 2030 sales.
When you say not too bad, what does that actually mean, not too bad?
Well, if they were 5 times, we would think they were fully valued.
Right. So there is still a lot of growth potential, is what you're saying.
Absolutely. Like I said at the beginning of the year, the valuations haven't really moved materially since then. The bank is saying that M&A order books red hot. So if pharma is willing to pay the multiples they've always paid historically, then the sector's not looking overbought in that, revenue growth names.
So finally, in terms of the trust, in terms of what you're seeing in terms of supply and demand, we know there's been a lot of change in the investment trust sector over the last few years. Supply being excessive, perhaps you could argue in many cases, and demand being lackluster. So there's been a mismatch between supply and demand, and that brings us on to your discount. Your discount is maybe around 8, I think, something like that. Is that right?
Yeah.
Yeah. And so you have been buying back shares. What's the latest picture? I mean, the last 2 financial years that we have data for, you bought back 8.7% in the 2025 financial year and 6.9% in the 2024 financial year. What's it looking like at the moment?
Actually, we've taken a step back on buybacks recently. We still do them. You can tell when we do them, it tends to be when we hit double digits that our broker will step in and support the share price. But since sort of November time, buybacks are much quieter. I don't have the year-to-date figure, though, off the top of my head, but we've taken a step back on the buybacks.
And in anecdotal terms, then, what are you hearing? Is this a question of more people coming back to the sector on the back of the performance, or?
So, yes, I do.
Right. So there is an improvement in sentiment towards the sector, which is, I guess, what you'd expect after this strong run.
Exactly right. And we've seen some changes in some of our competitor names. Maybe that's driven some buying of us, but certainly our discount has come in and stabilized such that we're not regularly buying back anymore, which is helpful. And it must be demand.
I did say finally, but finally one more. Everyone would expect me to ask this question, even though it perhaps isn't that relevant here. But what is the impact of AI as far as the areas you're investing in are concerned? I mean, we've heard a lot about how one of the things that AI is very good at in terms of coding is to do with protein analysis and things like that. What can you tell us about that, and whether it's potentially a positive or negative as far as biotech is concerned?
I can't see how it would be negative. So in terms of the industry and drug development, machine learning, which has been used, frankly, in this sector for many years, will potentially mean that there are many more different compounds that could maybe be considered or go into clinic. But there's a funnel, and all of these compounds need to go through clinical trials. You have to rely on capital and patients, etc. So there's a bottleneck there. However, finding those patients absolutely will be improved by AI. Crunching the data after a clinical trial reads out will be improved. The FDA have been very vocal about using AI to hold the hand of the company and doing much more real-time analysis of a clinical trial such that they could reduce the time to approve the drug, because a lot of time is spent by the regulator crunching through data in a filing application. But if that can be done real time, of course, that will improve timescales. So the rule of thumb that people are predicting, this isn't borne out yet, is that a drug approval process takes about 10 years, and maybe AI could reduce that to, say, 7. And then once the drug's on the market, again, the marketing company or the biotech company, or whoever's selling the drug, can use AI to find and locate patients. Doctors can use AI to diagnose patients better. So there's all across the life cycle from drug discovery to patent expiry, AI will be used. And I think making the whole system more efficient. I can't see how it would be damaging to the sector. It's not going to replace clinical trials, but certainly all other aspects should be improved.
Well, that sounds like a positive for the sector, as you say. So I'd like to thank you very much for taking part in this podcast, Ailsa. Thank you very much for your insights and help. And let's hope that the positive trend in the sector continues.
Thank you, Jonathan.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.